Are you starting to feel like getting the right loan for your BRRRR deal in 2025 is harder than ever? You're probably hearing all the options: hard money, DSCR, bridge loans, private lenders, and thinking, which one actually fits my deal? And what's worse, the wrong loan structure can take a deal that should cash flow and turn into something that drains your wallet every month. Here's the truth. In 2025, BRRRR still works, but only if you match your loan structure to your strategy. In this video, I'm going to break down the best loan structures for BRRRR deals today. We're going to cut through the confusion, talk about what's working right now, and I'll share my insider tips so you can avoid costly mistakes. I've helped dozens of investors fund deals in today's lending landscape, and the ones who win. It's not about finding a magic loan, it's about choosing the loan that fits their plan. So let's dive into the best ways to finance your BRRRR deals in 2025 and how to set yourself up for success. Let's start with short-term loans. These are the tools that help you buy properties that need work, fund the rehab, and position you for the refinance. In 2025, this usually means hard money loans, bridge loans, or private rehab loans. These loan types are designed for speed and flexibility. They don't care much about your personal income or debt-to-income ratio. What they care about is the asset, the deal, and the plan. Short-term loans are perfect when you're picking up a property that's distressed. Maybe it needs major repairs. Maybe it's not financeable through conventional loans right now. These loans are best for projects where you have a clear timeline, usually 6 to 12 months, and a clear exit plan. Before you even close, you need to know: how long will the rehab take? When will you refinance? What will your ARV be? The mistake I see too often is investors taking out a short-term loan without a real plan for getting out of it, and that's where people get burned. Here's an insider tip I will share. Get financing that will fund 100% of your rehab budget and 80 to 90% of your purchase price. But, and this is critical, always read the fine print. Make sure you understand how they structure draws, what the fees are, and what the timeline is for reimbursements. A lot of headaches can be avoided just by understanding these details up front. And you should know hard money loan rates in 2025 can range wildly. Some deals are closing at 9%, others at 15%. That's nearly double the cost, depending on the lender, your experience level, and the deal itself. That's why shopping around and negotiating matters so much. Once you rehab the property and it's rent ready, that's when long-term financing comes into play. This is the loan that lets you refinance out of your short-term funding, pull your cash back out, and stabilize the property with a monthly payment that makes sense for your cash flow goals. In 2025, DSCR loans are still one of the most popular tools for BRRRR investors. DSCR stands for Debt Service Coverage Ratio, which just means the loan is based on the property's ability to pay for itself through rent, not on your personal income or job situation. This makes DSCR loans especially powerful for investors who are scaling and maybe don't have a W-2 job to lean on anymore. The key is that your rental income needs to cover the mortgage by the lender's required ratio, often 1.25 or higher. Conventional loans, on the other hand, can still work, especially if you have great credit, stable W-2 income, and low personal debt. You might score a slightly lower interest rate with a conventional loan than with DSCR, but qualifying is harder, and you may hit limits faster if you're trying to build a large portfolio. Here's an insider tip: explore DSCR loans that offer interest-only periods for the first few years. This can give your cash flow a nice boost in those early years when you're still stabilizing the property or building reserves. And something that's changed in 2025. Some lenders now offer DSCR cash-out refinances in as little as 90 days, instead of making you wait 6 months. That can really speed up your BRRRR cycle and let you move on to your next deal faster. So how do you actually choose the right loan for your deal? It comes down to matching the structure to your plan. If you're buying a property that needs work, something where you'll be adding value through repairs, upgrades, or repositioning, you're probably starting with a short-term loan. These loans give you the flexibility to move fast, fund the rehab, and not get bogged down in qualification headaches. But the key is knowing exactly how you exit that loan. Have your refinance plan lined up. Know your timeline. Run your numbers at today's rates, not what you hope rates will be 6 months from now. If you're buying a property that's turnkey or close to it, maybe a light rehab or cosmetic updates, you might skip the short-term loan altogether and go straight to long-term financing. DSCR loans are great for this because they qualify based on the property's rent, and that can keep things simple if you don't want your personal income or DTI coming into play. One of the biggest mistakes I see is investors not sharing their full plan with their loan strategists. They just apply for a loan and hope it works out. But here's the thing, loan strategists can often structure a loan to better fit your strategy. If you're clear about what you're trying to do, are you planning to refinance in 6 months? Planning to hold long term? Want interest-only payments to maximize cash flow up front? Tell them. Deals where investors share a detailed exit plan with their loan strategist are 60% more likely to secure flexible, investor-friendly terms. That's a huge edge you can give yourself just by communicating clearly. And don't be afraid to get creative. In 2025, the investors who are winning aren't the ones waiting for rates to drop or for the perfect loan to appear. They're the ones using partnerships, seller financing, and BRRRR Cash to make deals happen now, at today's rates, with today's terms, and with a solid plan to win anyway. Here's the big takeaway. The best loan structure for your BRRRR deal in 2025 isn't about chasing the lowest rate or the lender with the flashiest ad. It's about matching your loan to your strategy, short-term or long-term, and making sure every piece of the financing puzzle supports your goal, building cash flow, equity, and long-term wealth. If this helped clear up how to think about BRRRR loan structures in today's market, hit that like button. It really helps other investors find this info too. I'd love to hear from you in the comments. What's been your go-to loan type lately? Where are you stuck figuring out financing? Let's start a conversation, because trust me, you're not the only one working through these decisions right now. And of course, subscribe so you don't miss future videos on smart financing, real deal breakdowns, and strategies that actually work. Don't forget to subscribe for more clear, practical BRRRR strategies and financing tips. Go watch the next video shown on your screen and click the link in the description if you want help structuring your next loan the smart way.